Ever felt like the housing market was stuck in traffic with no end in sight? That's the reality we're facing today. Recently, experts have observed a peculiar phenomenon. The housing market seems to be stuck in a state of gridlock, with transactions slowing down and frustrations mounting. Mortgage rates crossed the 7% threshold in mid-April and jumped to an average of 7.17% for 30-year fixed-rate loans in the week, according to the latest data from Freddie Mac. In a sense, the gridlocked housing market has been feeding on itself, Andy Walden, vice president of enterprise research at Black Knight, said in a statement. This gridlock, they say, is largely influenced by a significant factor: interest rates. By the end, we'll explore how interest rates affect the housing market, why they're projected to remain stagnant until 2025, and how individuals can navigate through this challenging period. Historical context. To truly understand the housing market gridlock, let's take a journey back in time. Throughout history, interest rates have played a pivotal role in shaping economic landscapes and influencing housing market dynamics. The housing market is on pace to have its worst year for sales since 2010, or possibly even since 1992 or 93, said Lawrence Yun, National Association of Realtors chief economist. Owning a home is a big part of the American dream. However, this has now become unattainable for many people. The U.S. median house price has jumped over 40% in the past 4 years to a near record of over $420,000 as per Redfin data. And to make matters worse, 30-year fixed mortgage rates soared from 3% at the end of 2021 to almost 7%. The reason for this price hike is that the Federal Reserve hiked its benchmark interest rate from nearly 0% to over 5% to curb inflation. According to Treasury Secretary Janet Yellen, this created a lock-in effect. Earners of about $75,000 should be able to buy about half of all listings, but currently they can only buy about 23% of them, says Nadia Evangelou, a senior economist at the National Association of Realtors. This began with the pandemic, which left a persistent non-healing wound on the economy. This left a permanent strain on societies worldwide, reshaping various aspects of daily life, including the housing market. From 2012 to 2019, even before the pandemic, the U.S. housing market was already in overdrive. The price of an average American home surged to over 50% during this period. Then came the pandemic, which led to a frenzy of buying and selling homes. At the onset of the pandemic, housing markets experienced unprecedented uncertainty. Lockdown measures, economic shutdowns, and widespread job losses contributed to a temporary slowdown in housing activity as buyers and sellers adopted a cautious approach. The sudden disruption in economic activity led to hesitancy among potential buyers and sellers, resulting in decreased transaction volumes and increased market uncertainty. Moreover, the pandemic-induced economic downturn mobilized central banks and governments to implement monetary countermeasures, including historically low interest rates to support economic recovery. This created a supply and demand mismatch, which made property prices go into warp speed. The price of an average American home is now at an all-time high. Imagine the economy as a bustling highway, with cars representing different economic factors and events. The pandemic, like a sudden roadblock, brought the flow of traffic to a halt, causing chaos and uncertainty. In response, central banks acted as traffic controllers, implementing measures to manage the congestion and keep the traffic moving smoothly. A 3% difference on a mortgage is gargantuan, Channel said. You'd have to buy a house worth tens of thousands of dollars less to pay the same monthly rate. We have a convoluted market where there's not a lot of demand and people aren't actively looking to sell, but prices are still up, Jacob Channel told the Business Insider. By examining these historical patterns, we gain valuable insights into the cyclical nature of the housing market and the profound impact of interest rates on its ebbs and flows. The role of interest rates. Okay, imagine you're driving a car on a road. The road represents the housing market where people buy and sell houses. Now think of interest rates as the gas that makes your car move. When the gas prices are low, it's like having a full tank of gas. You can go wherever you want. Similarly, when interest rates are low, it's easier for people to buy or sell houses because borrowing money is cheaper. But when interest rates are high, it's like having only a little bit of gas. You have to think twice before going on a long trip. Interest rates significantly affect the housing market. These rates represent the cost of borrowing money, determining the affordability of mortgages for home buyers and impacting the returns on investments for lenders. When interest rates are low, borrowing becomes more accessible and affordable, stimulating demand for homes and encouraging investment in real estate. Conversely, when rates are high, borrowing becomes more expensive, deterring buyers and slowing down market activity. Low interest rates act as a catalyst for the housing market, fueling demand and propelling transactions forward. Home buyers are interested in taking out mortgages at lower costs, expanding their purchasing power, and increasing their willingness to invest in home ownership. Likewise, existing homeowners may feel like refinancing their mortgages to capitalize on lower interest rates, freeing up additional funds for consumption or investment. Low interest rates have a ripple effect across the economy, stimulating other sectors such as construction, renovation, and home improvement. Increased demand for housing leads to job creation and economic growth, further reinforcing the positive feedback loop generated by low interest rates. On the other hand, high interest rates act as a brake on the housing market, constraining affordability and lowering demand. Higher borrowing costs reduce the purchasing power of home buyers, making home ownership less attainable for many. As a result, potential buyers may postpone their home purchases or opt for more affordable housing options, leading to a slowdown in market activity. In short, interest rates play a key role in shaping the dynamics of the housing market, affecting both supply and demand trends, as well as investor behavior and market sentiment. Understanding the relationship between interest rates and the housing market is most important for navigating market fluctuations and making informed decisions regarding home ownership and real estate investments. Please take 2 seconds to help me out. Hit the like button and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keeps us motivated to keep making great content. Thank you. Now, back to what I was saying. The current situation. Here's the deal. Experts are saying that interest rates won't change until 2025. That's a long time to be stuck in standstill traffic. So why are interest rates staying put? Well, it's like the gas prices at the pump. They're not going down anytime soon, and that's making it harder for people to afford homes. Imagine you're in a car and you need gas to keep moving forward, but when you get to the gas station, you find out that the prices are sky high, and they're not coming down anytime soon. That's what it's like for home buyers who need to borrow money to purchase a house. With interest rates staying high, borrowing money becomes more expensive, making it tough for people to afford the homes they want. Now, think about sellers who want to put their homes on the market. They're facing a dilemma too. With interest rates high, potential buyers are hesitant to make big purchases, like buying a home. So sellers are stuck waiting for buyers to come along, hoping that someone will be willing to pay the price they're asking. According to Redfin, on average, the number of homes sold was down 9.52% year over year, and there were 407,710 homes sold in March this year, down from 450,618 homes sold in March last year. The national average 30-year fixed-rate mortgage rate is at 7.6% and up 0.3 points year over year. Nearly 40% of homeowners reported they could not afford to purchase the home they live in if they were to buy it in the current market, according to a Redfin report. Thanks to surging mortgage rates and home prices, a borrower who wants to buy a median-priced $420,000 home today, financing with a 30-year mortgage, now faces a monthly payment of $2,864, or much more depending on the property taxes, the highest average ever recorded. In comparison, someone who purchased a home at the same price in 2019 with a 30-year mortgage at 4% is paying $2,210 monthly, or about $650 less. The median home sale price rose from a year earlier or stayed the same in all 50 of the most populous U.S. metros during the 4 weeks ending April 28th, the first time this has happened since July 2022. Nationwide, the median sale price rose to a near record $383,188, up 4.8% year over year. Mortgage rates also continued to climb, with the weekly average hitting its highest level in 5 months. High prices and rates drove the median monthly housing payment to a record $2,890, up 15% year over year, according to Redfin. In a nutshell, the housing market is feeling like a game of bumper cars right now. Buyers and sellers are bumping into each other, trying to navigate through the gridlock, but it's tough going. People who want to buy homes are finding it hard to afford them, while sellers are struggling to find buyers willing to pay their asking prices. It's like everyone is stuck in a never-ending loop, waiting for something to change so they can move forward. Anticipated interest rate stagnation. But why are interest rates expected to stay stagnant for so long? Well, it's like a complicated puzzle with many pieces. One piece of the puzzle is the economy. When the economy is strong, interest rates tend to rise as central banks try to keep inflation in check. On the other hand, when the economy is weak, interest rates tend to fall to stimulate borrowing and spending. Right now, with the economy still recovering from the impact of the pandemic, central banks are keeping interest rates low to help fuel economic growth. Another piece of the puzzle is inflation. When prices rise, the value of money decreases, leading to higher interest rates to compensate for the decreased purchasing power. However, despite concerns about inflation in the wake of pandemic-related stimulus measures, inflation has remained relatively subdued. This has given central bank leeway to keep interest rates low to support economic recovery without worrying too much about inflationary pressures. Additionally, global economic uncertainties such as geopolitical tensions and supply chain disruptions have also contributed to the anticipation of interest rate stagnation. These uncertainties make it difficult for central banks to gauge the appropriate timing and magnitude of interest rate adjustments, leading to a cautious approach to monetary policy. The MBA's forecast suggests that 30-year mortgage rates will fall into the 6.4 to 6.7% range throughout the rest of 2024, and Fannie Mae is forecasting the same. NAR believes rates will average 7.1% this quarter and fall to 6.5% by the end of 2024. The Federal Reserve announced that it would keep its key interest rate unchanged at between 5.25% and 5.5%, making it the highest level in more than a decade as annual inflation rates continue to stall. According to recent Fed projections, economists don't see inflation lowering to 2% on a consistent basis until 2026. This means that there will be higher but declining short-term interest rates for the next 2 years. However, inflation could still be falling steadily between now and then, meaning lower mortgage rates will probably drop more or less in response. But with nearly 90% of homeowners with mortgage rates under 6%, they'll have to fall well below that level to prompt sellers who can afford to wait. According to U.S. News, it's estimated that home prices, after falling 0.8% year over year through December 2023, tracked by the National Association of Realtors, are forecast to rebound by 1.8% to $390,000 by year-end 2024. By 2025 through 2028, given the large run-up from 2021 through 23, home prices are predicted to rise more gradually, at about a percentage point above the rate of inflation, for an estimated increase of 13 to 14% from 2023 levels. So what does this all mean for the housing market? It's like being stuck in traffic with no clear end in sight. Buyers and sellers alike are feeling the effects of interest rate stagnation, with borrowing becoming more expensive and transactions slowing down. Navigating through the gridlock. But don't worry, there are ways to navigate through this housing gridlock. Just like when there's a traffic jam, sometimes you have to find a different road to get where you want to go. One important thing to remember when you're stuck in a gridlock is to be patient. Patience means waiting calmly and not getting frustrated. It's like when you're waiting for your turn to play on a swing at the playground. You know that eventually it'll be your turn, so you wait patiently until then. Similarly, in the housing market gridlock, patience is key. Even though it might seem like you're not making progress right now, things will eventually get better. By recognizing that the current slowdown is temporary, individuals can adopt a wait-and-see approach, holding off on major decisions until market conditions improve. This patience allows buyers to avoid overextending themselves financially and sellers to wait for better offers. Along with patience, it's also important to be creative and think outside the box. Being creative means coming up with new ideas or solutions to solve a problem. In the housing market gridlock, you can try thinking of new ways to achieve your goals. Instead of buying a house, you might consider renting for a while until the market improves. Or you could look for special programs or assistance that can help you buy a house despite the challenges. Since 2021, rents continued to rise in 2023 at a much slower pace. For 2024, rents are predicted to remain stable and rise slightly for single-family homes. However, given the ample new supply of multifamily units, apartment rents are predicted to fall slightly, while also offering concessions such as a free month to tenants if they sign a lease. By 2028, rents for single-family homes will rise faster than for multifamily residences, due both to the growing popularity of build-to-rent homes as well as the excess supply of apartments taking more time to absorb, according to predictions by the U.S. News. Just like there are many different roads you can take to get to your destination, there are also many different paths you can take into the housing market. For example, some people might decide to wait until interest rates go down before buying a house. This is like taking the scenic route. It might take a little longer, but the journey will be worth it in the end. Others might choose to explore alternative options, like buying a smaller house or looking for homes in different neighborhoods. This is like taking a detour. It might not be the route you originally planned, but it could still get you where you want to go. You can consider creative financing options or seek out government programs and incentives that can provide assistance to those looking to enter or exit the housing market. Furthermore, staying informed and adaptable is crucial in navigating through the gridlock. Monitoring market trends, staying updated on policy changes, and seeking professional advice can empower individuals to make informed decisions tailored to their unique circumstances. Flexibility and openness to alternative solutions may lead to unexpected opportunities, even in the midst of market stagnation. Ultimately, navigating through the housing market gridlock requires a combination of patience, exploration, and adaptability. By embracing these principles, individuals can traverse the challenges of the current market landscape and position themselves for success in the long run. Thanks for watching, and please make sure you subscribe if you enjoyed the video and watch this one as well.